On the 28th of April, 1925, inside the House of Commons at Westminster, Winston Churchill stood before a packed chamber to present his budget. At that moment, he served as Chancellor of the Exchequer. He had not yet become the wartime leader history would remember, but he was already known for his confidence, ambition, and flair for dramatic political decisions. During the speech, Churchill revealed that Britain would restore the pound sterling to the gold standard at its pre-war parity. The exchange rate would be $4.86.86 for every pound, exactly the same level that existed before the war, the same value from the era when Britain stood at the center of global power. The announcement was welcomed by the financial newspapers. It was celebrated by the City of London. The Bank of England, which had strongly pushed for this outcome, also supported the move. The return to gold was portrayed as a declaration that Britain had regained its position at the heart of international finance. It was presented as the restoration of monetary stability after years of disruption following the war. It signaled to the world that the empire had recovered and was prepared to resume its leading role. Within weeks, John Maynard Keynes released a pamphlet titled The Economic Consequences of Mr. Churchill. In it, he described the decision as a massive mistake. Using arguments that were both technically detailed and politically damaging, he explained why restoring the pound at its old parity would harm British industry, create widespread unemployment, and speed up Britain's financial decline. His warnings received little attention. Years later, Churchill would describe the move as the greatest error of his political life. The decision helped push him into nearly a decade of political isolation. More significantly, it weakened the financial base that supported the British Empire. The effects, according to many observers, can still be seen a century later. The problem was not the decision to return to gold itself. The problem was the exchange rate chosen. To understand why that choice proved so damaging, it is necessary to understand what supported sterling's position in 1925. The common version of British financial history often simplifies the reality. The foundations beneath sterling were more complex than many people assume. Throughout the 19th century, the pound's global dominance did not rest mainly on military strength, although that certainly contributed. Its true foundation was economic. Britain was the world's largest creditor nation. Its industries were the most productive anywhere on Earth. Its exports generated trade surpluses that provided genuine support for sterling. When other nations held pounds, they were effectively holding claims on the world's most productive economy. Gold convertibility simply reflected an underlying economic reality. The First World War transformed that reality. What changed more slowly was the perception of it. By 1925, many policymakers had not fully absorbed how dramatically conditions had shifted. To finance the war, Britain had sold approximately 1/4 of its overseas investments. These were assets accumulated during more than a century of commercial leadership around the world. The country had also borrowed $4.7 billion from the United States, changing its position from the world's largest creditor into America's largest debtor. Its manufacturing sector had spent 4 years focused on wartime production and faced major difficulties, transitioning back to peacetime exports. The trade surpluses that once supported sterling had disappeared. In their place came persistent deficits. By 1925, the pound was not worth $4.86.86 according to purchasing power parity. It was not worth that amount based on trade balances. By any realistic assessment of what British exports could earn in world markets, the value was closer to $4.40. Churchill fixed the exchange rate at $4.86.86 because that had been the level before the war. That earlier rate belonged to a world power. Accepting a lower value felt too much like acknowledging decline. The consequences followed immediately and predictably. British products priced in pounds at $4.86.86 were roughly 10% more expensive in dollar terms than they would have been at $4.40. Coal exports from Britain became more costly. Textile exports became more costly. Steel exports became more costly. Virtually every major British export suddenly carried a price about 10% higher in the international markets that mattered most. British workers did not suddenly become less efficient. The problem was different. The exchange rate had been fixed at a level designed to protect a reputation that the economy itself could no longer sustain. The coal sector, employing more than 1 million workers, entered a severe crisis within months. Mine operators pushed for wage reductions in an effort to regain competitiveness that had been undermined by the exchange rate policy. The miners rejected those demands. The general strike of 1926 emerged as a direct political result of the monetary choice made in the House of Commons the year before. This was the exact process set in motion by Churchill's decision. It is also the same process faced by any issuer of a reserve currency attempting to uphold a monetary standard that its real economy can no longer genuinely support. When a currency is valued above what economic conditions justify, adjustment does not occur through the exchange rate itself. The rate remains fixed. Instead, correction appears elsewhere. It moves through wages. It moves through prices. It moves through employment levels. It moves through deflation, the internal process by which an economy seeks to recover competitiveness when a currency devaluation is politically impossible. Britain endured this adjustment for 6 years. Real wages declined. Unemployment remained above 10% throughout the latter part of the 1920s. Even while the United States experienced strong growth, domestic demand inside Britain was constrained by the deflationary pressures required to support a pound valued above what the underlying economy could reasonably defend. In September 1931, Britain abandoned the gold standard regardless. The worldwide financial crisis, intensified by bank failures in the United States, made continuation impossible, no matter how strong the political commitment remained. The pound immediately dropped to approximately $3.50. That level stood well below the $4.40 indicated by purchasing power parity back in 1925. 6 years of hardship had failed to restore Britain's competitive position. Instead, the adjustment had merely been postponed while imposing substantial costs on British workers and British industry along the way. The financial supremacy Britain hoped to protect by restoring gold at $4.8686 did not survive the effort to preserve it. By 1931, sterling's international role had been permanently reduced. By 1944, at Bretton Woods, that reality became official. The dollar would serve as the world's reserve currency. Britain would occupy a secondary position within the financial system it had created and dominated for a century. Churchill's error was not the return to gold itself. His mistake was prioritizing the image of British financial strength over its underlying reality. For 6 years, the appearance of sterling's pre-war standing was maintained at tremendous economic expense. In the end, that status was lost anyway. The difference was that Britain had less economic resilience left to absorb the loss than it would have possessed in 1925. This is why the story remains relevant in 2025. It is also why events from Britain in the 1920s extend beyond the boundaries of history. Every reserve currency eventually encounters the same dilemma that confronted Churchill on the 28th of April, 1925, when the economic foundations supporting a currency's global position begin to change. Should the issuer openly recognize that change, or should it preserve the appearance while the underlying reality gradually moves in a different direction? The dollar today occupies a position similar to sterling in 1925, not because it is weak. The dollar remains the dominant global currency by a substantial margin, and American financial institutions continue to rank among the largest and most advanced in the world. Yet in the specific structural sense relevant to this story, the economic conditions supporting the dollar's reserve currency role have changed significantly from those that originally established and justified that role. In 1945, just as Britain had been in 1890, the United States was the world's largest creditor nation. It was also the largest manufacturing power. Its economy generated the trade surpluses that provided authentic support for its currency. By contrast, in 2025, the United States is the world's largest debtor nation. It operates with annual trade deficits of $2 trillion. Its manufacturing base has experienced continuous decline over the course of 4 decades. The dollar continues to hold reserve currency status because the global financial system constructed around it still carries tremendous momentum. Alternative systems remain incomplete. At the same time, openly recognizing the widening gap between the dollar's international role and the present condition of the American economy would mean accepting a reduction in prestige that no administration has been prepared to acknowledge. Churchill faced a choice. He could accept a difficult adjustment in 1925, or postpone it and face a harsher correction in 1931. He chose postponement. The 6 years that followed imposed severe economic costs and reduced Britain's ability to handle the adjustment when it finally arrived. Those responsible for managing the dollar now confront a comparable situation. The Moody's downgrade of 2024 represents, in structural terms, the first major outside recognition that the distance between the dollar's reserve currency position and America's fiscal fundamentals has become measurable. This is not yet 1931. It more closely resembles the later years of the 1920s, when warning signs could already be seen by careful observers, yet the system still functioned well enough that political leaders were not compelled to confront the deeper issue. What happened after 1931 is especially important. Not the dramatic version often remembered, but the actual sequence of events. Britain did not collapse when sterling left gold. In fact, the economy recovered reasonably well throughout the 1930s and performed better than nations that remained tied to gold for a longer period. The devaluation Churchill had refused to accept in 1925 ultimately proved manageable when it finally occurred. The disaster was not the adjustment itself. The disaster was the 6 years spent enduring unnecessary deflation and unemployment in an effort to avoid that adjustment. Those years also inflicted lasting damage on British industrial strength and political stability. By 1944, Britain arrived at Bretton Woods as a debtor nation rather than a creditor. It accepted a financial framework designed by the United States, not because it preferred that outcome, but because no practical alternative remained. The $3,750,000,000 American loan of 1946 came with conditions attached. Among those requirements was the early restoration of sterling convertibility. Britain agreed because it lacked the leverage to reject the terms. The empire that had governed half the world 200 years earlier was now borrowing funds from its former colony to keep government finances operating. The monetary decision made in April 1925 was not the sole cause of this outcome. However, it accelerated an existing trend that might otherwise have unfolded more gradually. It imposed costs that weakened Britain's bargaining power during critical negotiations. It also demonstrated a broader principle, extending the appearance of financial strength beyond the point that economic reality can sustain does not preserve actual power. Instead, it determines how much will be sacrificed attempting to defend it. At some level, Churchill understood the exchange rate was problematic. John Maynard Keynes told him directly. Members of his own treasury expressed concerns as well. Nevertheless, he proceeded. Publicly admitting that the pound no longer justified its former value felt too much like declaring imperial decline. The irony was profound. The effort to prevent that acknowledgement became one of the forces that accelerated the very decline it sought to hide. Every issuer of a reserve currency eventually encounters this challenge. The central question never changes. How much time passes between the moment the underlying reality shifts and the moment the formal structure is adjusted to reflect it? Britain delayed that adjustment by 6 years. The result included the general strike, years of avoidable unemployment, and a weakened position in every major negotiation that followed. As this story comes to a close, one lesson remains clear. History often turns not on whether change is necessary, but on how long leaders choose to postpone it. The longer reality and policy move apart, the greater the eventual cost of bringing them back together. If you found this examination valuable, share your thoughts and continue the conversation. Your perspective on these historical lessons and their long-term consequences remains an important part of the discussion. Please leave your thoughts about this content in the comments below. Thanks for watching. See you in the next one.